So Brynne told us that she's on her way. And I think that the best way to start is for each one of you to introduce yourselves to the participants, to the audience. So why don't we start with you, Carol? And hopefully in the next couple of minutes, Brynne will be here also.
Okay, terrific. So my name is Carol Pepper. I'm the founder and CEO of Pepper International. And for the last 20 years, this is my 20th anniversary, I have helped families set up family offices all over the globe. I also act as the Chief Investment Officer to several large single family offices with a big focus on impact investing and in direct investments. I speak on CNBC and Bloomberg Television about the markets. I wrote a book called The 7 Pearls of Financial Wisdom, A Woman's Guide to Enjoying Wealth and Power. This year, I joined the Advisory Council of the United Nations Capital Development Fund, and we're working on developing the 46 poorest countries in the world, which is really fascinating. And I'm about to launch a wonderful new venture with some phenomenal partners called Family Office Carbon, which will allow family offices and sovereign wealth funds and foundations to create carbon credits with their land and to participate in this new market that's really going to help climate change significantly.
Stephen?
Good afternoon. Marty, thank you for having us. I'm Stephen Hirth here in New York City. And when people ask what I do, I say my raison d'etre is to have a positive impact on at least 4 people every day around the world. And I achieve this using either my family office, my family foundation, where we focus on health and education, domestically and internationally, and I have a traditional European style merchant bank, where I co-invest my own funds with other families, domestically and internationally, in predominantly growth companies, but mostly it's in companies or in industries where we understand what's going on and where we can have a real impact. And I'll talk about impact in a little bit.
And my name is Howard Cohen. I'm an advisor with strategies for wealth and Parquet and Securities. And primarily I work with business owners, family businesses on business exit planning, continuity planning, and executive benefits. And I guess I'm a decent moderator because this is my 3rd time. So Carol, since you only have 20 minutes, can you speak a little bit about the trends that you see in family offices for 2022?
Yes, I think, people have fairly well survived a very tough year in 2021. Although for some people it was an amazing year, it depends. You had a very, very good year and your segment of the market went up significantly. Some people are awash in cash and other people had a tough year, particularly people that own a lot of commercial real estate and things like that. So, but everybody's girding up for 2022 to be a better year for investing. We're sort of poking our noses out and hopefully being able to travel again. And I do see a continued emphasis on venture capital and direct investing and impact investing as the alpha generating sections of someone's portfolio. So I would say people are now much more having their cash kitty be a larger percentage of the cash that they have. I see most families are taking 2 to 3 years worth of personal expenses and sticking them on the side and to defease their liabilities. So if we get another pandemic or something else terrible happens, there's enough cash around to pay the bills. And then looking at the public markets, as a beta play, basically are going to get what the market does. They're very hard to beat the market. And so more and more movements into passive structures like ETFs for public market equities. And then really very much the laser focus on venture capital, direct privates, and impact as the place for alpha. Nobody really, frankly, in my book, believes that alpha is going to be in hedge funds anymore. It's much more the private directs and some of the funds if they're very specialized. But most families, I don't know, Stephen, if you've seen this, most families now are much more eager to be directly involved in the companies. They all made their wealth by building businesses, and so they want in on the directs because they feel like they can bring value.
And Steve, where do you see the opportunities for co-investments domestically and globally?
Mm-hmm.
I think that, Howard, I think they're everywhere. And I don't even think that I know it. I say this and I practice it. Marriage is cheaper than divorce.
Yeah.
If you're a family office, you're going to make an investment with someone. and you're going to write a 5-figure check, a 6-figure, a 7-figure, invest a few bucks, get on a plane, get on the train, and go and meet the people. I think this is a fallacy. Many things. People today have said, well, we have Zoom, we've learned from the pandemic, we can do Skype, Zoom, and WhatsApp. That's all great. Technology is a super tool. Money is a super tool. But if you don't get physically next to people, at least what I do, you miss something. Prior to the pandemic, I traveled about 200 days a year around the world. And I'd go to the Middle East, I'd be in Asia, I'd be in Europe, and I'd be asking people got to know me as the why guy, because I wanted to understand what was going on. And today, we have found so many wonderful opportunities. Europe has better valuations. There's phenomenal technology coming out of the Middle East, whether it's the UAE, even parts of Saudi Arabia. You see, what people don't realize is, for many years, over 250 to 300,000 young women and men, for people get the women, came from Saudi Arabia, studied in the United States. They go home, they're doing extremely well now, and they're great opportunities. We're gonna be there in January, but it's the accountability. And even here in the United States, I had dinner last night. Marty organized a phenomenal dinner, and one of the guys at the table was from Arizona. Talked about the real estate. A lot of people in the Northeast don't know what's happening in Arizona, and it's so close. So for me, it's making yourself physically accountable, meeting the people, and going to it. And if you don't know someone, contact someone like Carol, contact others. That's one of the key things with the family office space. You make yourself accountable and you show up, people will really be genuine.
Agree.
Well, I'm happy to see that Brynne is logged on. And if you unmute yourself.
Yeah, hi there. So sorry about that. I'm Brynne, very happy to be here. Do you want me to introduce myself?
Yes, sir.
Okay, perfect. My name's Brynne Kennedy. I am a partner at a new venture capital fund called BCP Blitz. That stands for Bifrost Capital Partners. We are a fund that combines venture capital investing and impact investing. Specifically, we believe that it is the combination of great innovation and capital that will solve the biggest challenges that we all face. And we specifically focus on 3 sectors: food and ag tech, climate and sustainability, and what we call security and wellness, because we believe that a society we want to live in is safe and it is healthy. We've got a handful of investments so far. We've got a very robust pipeline. We are actively raising, targeting our first close in a couple of months, but actively investing from the GP capital that we've all put in to scale the impact that we've made and the successes we've had through our own family offices and as angel investors. So again, it's called BCP Blitz. I've been to a lot of Marty's events in the past and always a great time. So thank you so much for having me again.
So to continue on a previous conversation that we had preparing for today, specifically, what do you think family offices are looking for in a manager, and why is the manager so important?
Well, I spend a lot of time with family offices, but I see it, I think, a little bit from a different side of the table. I guess maybe with 2 hats. I do have a portfolio of my own direct deals that I've invested in at the seed stage and often bring other people into. But my primary focus is raising our fund right now. So I speak to a lot of family offices from the perspective of them investing into our fund as an LP and understanding what it is that they would like to allocate to. And I think what I see across the family offices, certainly that I spend time with, and that this is cross-continental, is a real focus on 2 things as we look ahead. One is increasing exposure to the venture capital as an asset class and to early stage technology as an asset class. And I think that's driven by the incredible gains we've all seen over the last few years for the technology sector, some really big outcomes that people have had. And I see a lot of family offices who may have historically oriented toward private equity or growth or public equities saying, okay, now we want to get into venture. And quite a few of the LPs coming into our fund actually have no venture allocation, but we're looking to increase it and then decided to invest with us. The second thing that I see a lot of family offices really looking to increase exposure to is the impact investing side of the world. Some may call it ESG. I like the term impact because it looks at both the internal impact that you can make in a company, but also how your innovation or your business impacts billions of people's lives and improves something. And so that's really what I see across the landscape.
Carol, I want to make sure to give you time because you only have 20 minutes.
Mhm.
So you brought up the fact that families are putting significant amount of money into cash to be prepared for another event like the pandemic.
Mhm.
But at the same time, we're also all experiencing inflation now.
Mhm.
How do you feel that might affect the way the families are looking towards future investments?
Well, I think inflation, of course, is real. And at some point, the Fed is going to turn the spigot off, although the date keeps getting moved around, depending on whether Omicron is real or not, et cetera, or what the next little variation is that comes out. I think inflation is something that people are not thinking is going to be particularly long-term. There's still sort of supply chain issues and leftover issues from the pandemic, which of course Goldman, JP Morgan, et cetera, are all saying, this is not a terrible, we're not going into hyperinflation. We're not going into 20, 30% a year inflation right now. We don't have to slam on the brakes. So I suspect since 2022 is an election year, nobody's slamming on the brakes of the money next year, myself, from what I see. For the families, would you lose some? When I say they keep cash, I don't necessarily mean it's actual physical cash. It could be short-term cash equivalents. It could be a short-term fund that has a floating rate. People have different opinions about that. But I would say that people are certainly keeping their eye on inflation, and of course that drives tech in a positive way because people feel like tech investments are having such massive exits. And we just heard about it on the cybersecurity side, and I see it all the time, every day. If you get into the right early stage companies or a fund that can, particularly target the right early stage opportunities, you're going to make massive amounts of money. Or in our case, what I'm doing with some of my families is we are literally securitizing their land, creating these carbon credits. And also, we're going to create a fund for this because a lot of the sovereign wealth funds have asked us to do that. You can actually now go out and buy land, put a carbon credits project on that land, securitize the carbon that the land is capturing essentially, and the supply and demand is radically out of balance. So it's a bit like this high-end tech booming. So all the corporations by 2030 are mandated to become essentially net zero on their carbon. And if they can't, they have to either pay a massive tax or buy credits. So of course they're going to buy credits. So there's thousands of major corporations looking to buy carbon credits over the next few years. There are not thousands of projects in the pipelines yet to actually create real certified carbon credits. So the corporations are actually pre-funding these project developments. So not only can you do a project, but the project is funded by the end user. It'll be like building a building, and the guy who wants to live in the building funds 100% of the cost of the building. It's incredible. Because why? The prices are going up dramatically. So for example, when we did our models 2 months ago, we said that the voluntary credit market you would get paid about $10 a ton for the carbon you remove from the air. We're already hitting 20 in 2 months. The mandatory market, which is the carbon market for the big utilities around the world, that's blown from $60 a ton up to 100 already. So we're blowing through price projections because of the massive amount of demand from corporations for carbon credits versus the supply of credits, reputable credits that can be certified and are coming online. I could talk about it for hours, but there's no time for that. But anybody who's interested in that, let me know. The reason that I'm excited about it is for the first time that I've ever seen, Mother Nature and capitalism are in accord, because one of the ways you make the biggest carbon credit is you start with really badly damaged land. So that land, because a carbon credit is the amount of improvement, additional carbon capture you have created on the land. So let's say a piece of land has had terrible forest fires and it's only sequestering, say, 10 tons of carbon. I'm just making up a number. If you start replanting trees and putting that thing back together, your project projects you will now be able to capture 100 tons of carbon out of that land. That gives you a credit of 90. So the more damaged the land is that you build on and that you fixed and you reforest, the more money you will make, the bigger the credit is. And if the price of the credits are going up, then the more money you will make. So we have royal families, for example, that have huge, massive land holdings in Eastern Europe and places like that, who don't have the money to fix up their land. The corporations will pay them to fix up that land. We have land in Panama, land in the Philippines. It's literally global, and a lot of land in California. So I'm very happy because Mother Nature wants us to reforest the most damaged land, and the capitalists want to make the most money, and this is where you can do it. So, it's my latest passion. As you can see, I'm very excited about it.
We certainly do have passion behind it.
You know what, Howard, listening to Carol and Brynne, I agree with much of what they're saying, and people are using some words today that I grew up hearing them differently. So people talk about impact investing. So my parents came from Europe here, and I'm first generation American. And when they started doing direct investments, I remember distinctly as a kid, when they talked about impact, my parents would say, if we can invest in a company that's going to help create jobs and people pay their mortgages and put food on the table, that's a direct impact. I think that's key. I right now today have invested we're backing a SaaS technology out of Israel in the food, ag, beverage, and insurance space. We're backing MedTech out of Germany, a energy company of photovoltaic out of California. Those are all technologies. I've even seen a new technology for toilet paper. There's technology for everything today. So when people talk about technology, I throw that out, because if you don't have a technological component today to anything you're doing, I don't think there's a future for it. And what a lot of people do is when they talk about ESG, when I have my team do some analyses on the projects, we don't look at it just as environmental, is it social and governance. Do the projects empower the people? Are they enabling? Is there something sustainable about that? Is it for the greater good? Those are key points for us when we're doing the co-investments.
So Steve, I wanted to ask you also about how you go about finding your partners and your co-investors.
I lived basically throughout the United States, Southeast Asia, Europe, and the Middle East, and I've worked in many countries. And it's a lot about, when people talk about sustainability, and Carol was talking about the land and the environment and all that's out there, relationships are the same thing. And I think for family offices, going out, I work for different families. My parents sent me, and I volunteered to go and work with other families and learn what they were doing, and brought some of their knowledge in, and also some of the mistakes that they did, learn what we shouldn't be doing. So I'm very fortunate. I don't have any problem with deal flow. And I also invest still today, I've been traveling now since this summer. I'm going back for the 4th time to Europe. We'll be going to India and throughout the entire Middle East in January. And we're meeting different people, we're exploring. And showing up, it's I think 80%. People want to see who you are, what are you doing, and we've been able to develop great relationships around. And I think that is one of the key things. I repeat myself, but I don't mean to. Technology, the Zoom, the WhatsApp, the Skype, they're all great. But if you're a family office and you're going to get involved with a co-investment, get to know your partners well. Because when something goes wrong, you want to know that they're there and they will cover you or you'll cover them, which they don't do in the corporate world and in others. I think that's one of the key things. And there are so many young men and women, I advise families here in the States, there are so many young men and women who are studying in the US who are looking for internships. And they come from families of the entire world. Great resources, bring them in, teach them your ways. They'll go home and they say, I learned this at Cohen Enterprises. I learned this carving credits from being with Carol. Brynne taught me how to analyze and look at this type of company. They become the ambassadors for that portfolio and open up the doors for you in their countries when you want to go there.
Very well said, Stephen. I just want to say thank you, guys. It was lovely to be with you. Marty has my contact information. Unfortunately, I have to go, but lovely to see everybody and enjoy the rest of your panel. Thank you.
Bye-bye.
Bye.
Take care.
See,
Great to see you, Carol. Thank you.
See, what you were just saying about going to meet with companies all around the world reminds me, and if I believe it was American Airlines, had a great commercial once where the CEO of a company, and it was an anonymous company, the CEO of the company brought together all the top salespeople and executives of his company, and this is how old it was. He was handing out plane tickets to people saying, you're going to Dallas, you're going to Detroit, you're going to Los Angeles, and we're going to see the people who we work for.
Yeah. And
I think that that's great. And my feeling is about Zoom is very similar to yours. You don't have, with Zoom, as wonderful as Zoom is, you don't have those side conversations. You don't have a conversation like we had before. Yes. We were on a Zoom call that I was hoping to one day have with Brynne, if she would have been able to be here in person today. Being in person is very important.
If I may say something, you know, we talked earlier about technology, and I had an experience just a few weeks ago. I was invited to go to Utah for a family event, and whilst I was there, it was going on Silicon Slopes. Never heard of it. Never heard of it. The who's who of Silicon Valley was there. It is a major tech event. And then I started exploring what's going on. It's the 4th largest tech community in all of the Americas. And you see who's going in there. It is booming. And I'm so impressed with what I saw. The first week of February, I told people I'm going back out there. They said they're going skiing at Deer Valley and Alta. I said, no, I'm looking at tech companies, stuff. And I'm looking at ag companies, I'm looking at med tech companies. I have 5 families who said they'll take us around. It's just, we doesn't have to travel around the world. Within this great country of ours, just get off and go. And there's some great things to explore and see and discover.
Brynne, is there anything you want to add to that before I ask you the next question?
Yeah, I mean, Marty knows because I've been to many of his events, including in Miami last week in person, that I also believe very strongly in person. And I apologize for not being there. My schedule went a little awry today, actually because of a series of multiple events and in-person events, and I found myself in the wrong part of the city. But what I would say is I think that the use of Zoom has not replaced, but enabled some deal making and some relationship building at a broader scale. You know, the way that we look at things at BCP Blitz, both as we're raising funds, so in partnership with our LPs, and as we're investing in partnerships with our entrepreneurs, is we meet everyone. We get on planes. I've been in 6 countries in the last month. And we build relationships because fundamentally relationships are built on looking people in the eye and trust. That being said, I think now you can do it once through the course of a deal instead of every single meeting necessarily having to be in person. So when we look at deals, we may do the initial analysis and the diligence all virtually, but then fly to meet the company to make a final decision. Or we may meet the company and sort of say, we trust these people, we've built a bit of a rapport and relationship with them. Now we can do the analysis and the work and the follow-up virtually. And I think it's very much the same for LP conversations. And I think that gives you scale and it gives you efficiency.
Brynne, looking at 2022 and beyond, actually, we had this discussion a little bit about this the other day. The role of women and minorities in family offices and the VC world. We had many women panelists here earlier today. It's still a small percentage, and how do you see their trajectory going?
Yeah. Well, I can't necessarily speak for the family office side of things, but for the venture side of things, it's still a very, very small number of female partners. The actual statistic is that only 4% of venture capital partners or managers are female. So that's an incredibly small number when you think about the number of venture capital funds. And I think by the same token, allocators, whether they are family offices, institutions, pensions, or endowments, are very, very motivated to increase that number and to seed and back female, and it's not just female, by the way, it's BIPOC and other minority managers, because that brings a different perspective to investments. Often what you find is that when there's diverse managers, more diverse founders get funded, and it has a positive trickle-down effect. So I think there is a big push. I see it from the family office side of things and the institution side of things to increase the representation in managers. I am one of 4 partners at BCP Blitz. The other 3 are white men, and they are absolutely wonderful. But I mean, I was literally in a meeting today and an LP said, well, it's great that it's 25%, but your other 3 partners are white men. Come on, like the statistic is 4%. Like, are we really having this conversation right now? Like in Midtown Manhattan. So I think there is just a lot of interest in this. And I think it sort of correlates with the ESG and the impact conversation. What is the power of capital if you're an allocator to solve problems and change things in the world?
So Steve, what's really your process of determining where your money's going to be allocated?
I'll speak very subjectively. I think like several family offices, but I have different tools. So for the foundation, for the family foundation, we're targeting certain types of investments because we know the pledges that we make, we know the commitments, they're less risky. Then we have 2 boys, and for the future generations, that one is a little bit more, I would say, aggressive, and then I'll do things on my own. I won't do, and I tell people, and I think this is one of the great things with many of the families that I know, we've developed great communication with one another that we can say, for instance, I tell people, I don't deal with certain countries. I won't do direct investments in those countries. I don't deal with alcohol, not because I have anything against alcohol. I think it's just a marketing game. I don't deal with certain types of defense. There are certain sectors or industries. And other people tell me, we only deal with real estate, we only deal with, oil or gas or whatever it may be. So one of the areas is, I think what makes many family offices successful when it comes to investments is knowing what they don't want to do. I'd say publicly, I don't understand crypto and NFTs. I'm learning about it, but I'm not ready yet to make a substantial investment in that sector. Is it here for a while? Probably, but I'll start dabbling in it, but only once I become more knowledgeable about it. So each family, I know every family looks for what is good for him, her, his family, her family, and the generations. There are some friends of mine, they're fantastic people. They're not in any formal relationship. Their parents are currently no longer around. So their investments are only for them. And they have a different approach to doing the investing. But I am seeing more people going, thankfully, slowly, and Brynne, this is something I should talk about later on. I am seeing more people starting to go global, and I am seeing more people saying, where are the women? Where are the minorities? Running the funds or running companies. And that's become amongst many family offices I know, a criteria.
It's interesting, just piggybacking on that point. I shared this on our prep call, and it is interesting being in the midst of the fundraising process because I talk to potential LPs all day long, and they're mostly family offices and institutions. And it is incredibly rare when I meet a woman, incredibly. I can count on one hand. Our first closing is going to be about 50 million, and then we're raising another 200 in 2022. And we have soft circled more than 100 today, right? Of that 100 million, one of those people is a woman. And there's a lot of more junior women on the teams, and that's wonderful to see, but it does take time for things to change. And it does really start with how you build the next generation and how you lift people up, whether they're your daughters or your VPs or your female founders or investing in female managers. And all of that is super important. And I will tell you that occasionally, even in 2021, I do run into someone that still has a significant gender bias. About 12 years ago, I founded a software company called Topia that I was CEO of for a decade and led to global operations. That's a story for another day, but it was a good run. And the important part of this story is in 2010, when I started raising capital, I kid you not, the venture capitalists would say to me, women can't build enterprise software companies. We pattern match. We don't have any successful female CEOs. And we don't think, convince us you're tough enough. And Marty knows me a bit. I mean, I was an elite athlete. I worked on Wall Street. I built a tech company and I ran for Congress. Like, it doesn't get much tougher than that. But it was very eye-opening. And in 2010, we all just sort of said like, oh, that's the way the world is. But even today, there are still people that say similar things that I meet and the potential LP side. In fact, the other day, someone who claimed they were a large ESG investor said they thought our team was too diverse. And I said, well, our team is 3 white men and me. So do you mean me? We should talk about that. And I was like, that's like 2021 for we don't want to invest in a woman. Like, at least people are smart enough to know they shouldn't say that anymore. But it does still exist, and it does take all of us backing different managers, different founders, involving our daughters as we would our sons, and treating our VPs or our analysts or whoever it is the same.
We have a question over here. Maybe you should come a little closer so we can hear you.
Yeah, I'll speak up. Hey, Brynne, it's Rob.
Hey, Rob, how are you?
I'm good. It's good to see you in Miami. But the question for Howard, Steve, you all, in terms of expanding into a new either asset class or region, Steve, I heard your point with respect to crypto, but then there's probably some similar things. If you expanded into things like emerging markets or biotech or what have you, can you speak a little bit of process of getting comfortable? Because diversification is part of our strategy and portfolio, but you bring a fair point, but how do you get comfortable around that expansion?
Do I repeat the question? Yeah.
It's a long question, that's why I wanted him to come closer.
So the question is basically, and correct me if I'm wrong, when one's going into a new market or a new area, whether it's an investment area or a geographic area, what does one do and how can one become empowered or more enabled in that area or have a better understanding of that sector? Is that correct? So I'll give you a short story. About 20 years ago, I made my first trip to the GCC countries, the Gulf Corporate Councils, and I went to an event. It was in the United Arab Emirates. It was the end of November, beginning of December. I found out afterwards I was the only American family office principal at this event. And I got there, there's a gentleman sitting there in a brown toga, and I'd never seen a brown toga before. I walked over to him and I introduced myself. And I learned, I make a point in every country that I go to, I learn a few words, polite words, even if I mispronounce them, I do my best. So he started speaking to me in Arabic. I said, only know these words. I said, is this your native, dress or your costume? That's where he said, no, it's wintertime and it's cold. And I said, I grew up in northeastern Connecticut. You want to know what cold is? Come on over to see me. Turns out that he was the chairman of the event that day. And they opened up the event. The first few minutes were in Arabic and then it converted to English. And just before he started, we started the whole discussions, He said, one of the key things about family offices, so we get together, we know one another. And he went like this and gestured toward me and said, this young man made this and this comment. I was mortified. I wanted the lights to go out. I wanted to disappear. And everyone started laughing at me, and I felt really uncomfortable. We finally had the first coffee break. Mohammed comes over to me. I'm Mohammed from Oman. This is my post. I'm Ashraf from Qatar. This is my, and I had a GQ baptism by fire into the entire of the men of the Middle East. And then they started laughing with me. And then we just started getting to know one another. And I committed, they said, are you going to come and visit my country? I said, I will. You're going to come here? And for the first 2 years, I did no business over there, but I go over and I just got to know. Today, some of these men are family to us, literally. Their kids call me Uncle Stephen, my life partner is Aunt Nino. We share deals, we share things together. It's going over there. With crypto, and I'll be very specific, and the NFTs, there was a dinner I went to several months ago, and I learned about that Puerto Rico and Miami happen to be major centers now for this. So I got a list of people who are in that space, and I've written to them, I said, here's who I am. I know somewhere between bumpus and nothing about what you're doing, but I'd like to learn. When you come to New York, will you come to the house for a coffee or tea or a drink? And they're coming. And I'm just sitting there, I said, talk to me to a little kid to learn about it. But it's I'm comfortable in my own skin to say, I don't know. And this is what I see with, regrettably, a lot of families and people. They don't have the ability or the confidence to say, I don't know. Forget the charade. We're talking about more than money. We're talking about reputational risk here. So, going out and doing, and what Brynne just shared with us publicly, I've never met Brynne before. We just spoke now as him. I've got 3 or 4 principals or families where the matriarchs are running and calling the shots. And whether they like your fund or not, I have no idea, but I know they take the meeting with you simply because, say, here's a woman, 3 guys, I'm gonna help her, at least listen to her and see what's going on. So I think
Well, I'll be following up with you. The point on Wall Street, tech entrepreneur and elite athlete means if you say things like that, I will hunt you down.
I don't make gratuitous comments, and Carol Alex will say that. But it really is going out there. I mean, we've met a few times, we've talked, introduced me to Dave, we were talking about India, the whole thing. It's getting out there and knowing this. And Marty had last night, I forgot the lady's name, Marty, I apologize. She's originally from China, she studied at Yale. And she said to me, I don't meet many Americans who look outside and really think globally. We have to think globally today. We are living in a global world more than ever before. And as family principals, as family officers, if we don't get off our ducks and invest a few dollars to just say, I want to learn. If you go over and say, here, Howard, I'm selling you this, you don't want it, I'll take it. If you don't go to build the relationship, to communicate effectively, it ain't gonna happen.
So, Brynne, do you want to address that before I have one last question for the 2 of you?
Sure. Well, I am an entrepreneur, so I've spent much of my life learning new things about new sectors and new stages of my business. So, and I think, as an investor, you're always looking at what are happening in the world over the next 10 years. Like, what is my thesis? We focus on particular sectors, as I said, food, ag, tech, climate, sustainability, and security and wellness. But those are broad, and there's always new innovations, new trends, new things happening in different geographies. So you're constantly learning. And quite honestly, that's what I like better about being an investor than a CEO, is you have the opportunity to continually learn new things. And I think I would second what Howard said, that it's about asking a lot of questions and building rapport and relationships and surrounding yourself with experts, and not being able to afraid to say, crypto, I don't know a lot about, as an example, and educate me, other people that have been early on in this space, or educate me, people at Marty's conferences or some of the others, and learn. And quite honestly, I learn a lot from founders that I meet as well. I judged a startup competition at Columbia on Monday, and there were 10 presentations, and I was like, wow, I learned so much as the judge and the expert from these MBA students. So it's great to put yourself in those situations where you can consistently learn. But then to the geographic point, so we invest across the US and Europe at BCP Blitz. We have a multi-geography strategy. I like to say that great innovation happens everywhere, and now the whole world realizes that because of COVID, when everyone's moved. And our strategy reflects that, and also reflects the fact that those great innovations are not valued the same way based on where they are started. And so we're constantly looking at deals in different geographies. And again, it's about local ecosystem relationships, building them and being on the ground. At our fund, we say in the flow. If you're in the market for a week, things happen organically. You meet with people, they say you should come to this dinner, you should meet this person, and you can really immerse yourself in it and then drive follow-up and deeper understanding from there.
Marty, do we have time for one more question?
Last question.
Okay. So one of the things that we spoke about in our prep call, and I highly advise anybody who's going to be a moderator to do a prep call, because to get to learn about the people and find out what interests them. Earlier you spoke of, Carol and Brynne spoke about impact investing. And in the world that I'm in, people are always asking me about ESGs and if they're real, if they're not real, and how are you supposed to quantify if the ESG is real. And again, this is something for 2022 and beyond. How does the investor, the family office, the venture capitalist know what they're investing in really has that impact?
Yeah, I could take this because this is our one of our bread and butters is to combine venture and impact investing. And I think, what I see across the family office world, and quite honestly, the whole world, is that the default understanding is that venture and impact, or ESG, are separate asset classes. I think people often think about impact and venture as later stage businesses, ETFs, public equities, putting pressure on the BlackRocks of the world or whoever it is to divest of X, Y, and Z. Our argument is we're not going to solve any big societal problem without great innovation, and great innovation comes from entrepreneurs starting businesses. And many of those businesses will be worth many billions of dollars over the next 5 to 10 years. So we invest at the Series A stage. So I just give that context because in a lot of our conversations, people are saying, okay, this is a new idea, but we get it, and a light bulb goes off, so we want to invest in your fund, but tell us how you measure impact then, because it's easier to measure BlackRock's holdings or how Shell is allocating investment or whatever it is than it is to measure an early stage business. So we have two ways that we measure impact. One, or the primary one, is what we call, our fund is oriented around a smart society. So we've developed a proprietary smart society index. So for all of our investments, we run them through a smart society analysis that looks at their impact across about 24 different dimensions. Some may be negative, some may be positive, some may be really positive, but we have a minimum aggregate and a maximum floor that the investment has to hit to proceed. So this protects us from saying, this is a great return as a potential technology company, but it's destroying the environment. We won't do that deal. Conversely, we won't do a deal that is like solving climate change, but going to be a nonprofit investment, or not going to be a $1 billion company, or we don't see a path to at least a $1 billion company. So that's our first check. Our second check is that we talk with the entrepreneur about how they see the impact in their business. And then we put in the management rights letter, in addition to the standard financial reporting, quarterly and annual budget reporting on the impact KPIs that we've agreed as a part of that quarterly reporting package, which goes back to then our LPs and their quarterly reporting package. And what I see from a lot of this other conversations, we're very focused on ESG, like the internal pieces, the governance, the diversity, the stakeholder engagement, the engagement with the outside world, the carbon footprint of the company. Those are important. But what we like to look at even more deeply is how does this innovation impact billions of customers, externally, billions of people's lives, and solve a big societal challenge? And how do we quantify and measure that over time?
No, I agree with what Brynne said, and it ties into one of the questions earlier. If one doesn't know something, and let's focus on ESG. I think people are still trying to figure out what ESG is. And there's still, and large corporates are under pressure. They have to do something they don't know. But I'm going to speak only as from the family office perspective. If one wants to get involved with something in the environment that Brynne and her team are doing, and doesn't feel comfortable doing it directly, these are the types of funds and others. Start gradually and get exposure through that. That's one way of learning about it. A lot of things are that people say, well, it's going to help this, but it's going to then be disruptive in another way. And that finding that balance is they don't look at the broader aspect of it, and that's one of the key things. Is that if he's going to get involved and really active in the ESG,